Good evening, everyone, and welcome to our Dean Speakers event. The Dean Speakers series was created to bring to our campus outstanding scholars and leaders from the fields of business, education, and government to share thoughts and insights with UNC Kenan-Flagler students and faculty and staff, the university, and the community at large. The Dean Speakers series is made possible through support of the Archie K. Davis Endowment, and it's managed primarily by our students who select and invite the leaders they are most interested in learning from. Before I introduce this evening's distinguished speaker, I'd like to remind you of our next Dean Speakers event, which is on March 16th. We'll welcome Brent Kalinikos, who's treasurer of Google and a BSBA and MBA graduate of Kenan-Flagler. And I invite you all to join us for that lecture. I just met with Brent in California recently, and he said he's planning to talk about the differences between, he was also the treasurer at Microsoft, to talk about the differences between the corporate cultures at Microsoft and Google, which sounds like an inordinately interesting talk. At the conclusion of this evening's lecture, Jennifer Conrad, who is the Dalton McMichael Distinguished Professor of Finance at UNC Kenan-Flagler, will offer a vote of thanks to our speaker on behalf of faculty, staff, and students. Tonight, we're honored to welcome Elizabeth A. Duke to UNC Kenan-Flagler Business School. Elizabeth took office as a member of the Board of Governors of the Federal Reserve Board in August 2008. Which by coincidence is just about when I became dean, which shows neither one of us have much sense of timing. August 2008 to fill an expired term which was ending January 31st, 2012. Prior to her appointment, she was Senior Executive Vice President and Chief Operating Officer of Town Bank, which is a Virginia-based community bank, and prior to this, she was an Executive Vice President at Wachovia and Executive Vice President at South Trust Bank. Elizabeth served on the Board of Directors of the American Bankers Association from 1999 to 2006 and served as its chairman from 2004 to 2005. Excuse me. From 1998 to 2000, she served on the Board of Directors of the Federal Reserve Bank of Richmond, and she's also served as a member of the Fannie Mae National Advisory Council. And she is a Tar Heel, having graduated from UNC in 1974 with a bachelor's in fine arts in drama, which she's seen quite a bit of over the last couple of years. She received her MBA from Old Dominion University. She is a graduate of the Stonier Graduate School of Banking and the Virginia Banker School of Bank Management. Please join me in welcoming our distinguished guest speaker, Elizabeth Duke.
Thank you. Thank you. You stole a bit of my thunder, though. It is great to be back here at the University of North Carolina, and I'm most honored to take part in the Kenan-Flagler Business School's Dean Speaker Series. I am a proud Carolina graduate. However, my area of study here was not what you would think of as a logical first step for someone who would someday become a central banker. I was an aspiring actress. I spent most of my time across campus at Playmaker Theater, earning a degree in dramatic art. So tonight I've been asked to share with you some of the memorable experiences I've had since I was last in a Chapel Hill classroom. Some of the amazing opportunities that shaped my journey from Carolina Playmaker to Federal Reserve Governor. I'll talk a bit about banking and the important role that lending plays in the economy. I'll describe how my banking career led me to a seat on the Federal Reserve Board and how that unique perspective helped me to add value after I arrived there. I'll then explain some of the actions that were taken by the central bank at a time of extraordinary financial uncertainty, and I'll describe some of the attributes that make the Federal Reserve an institution like no other. I'll end with a few thoughts that might resonate with the students here as you conclude your studies and prepare to join the workforce. I chose a career in banking for one simple reason. I needed a job. Regardless of economic conditions, the acting profession has an unemployment rate of about 95%, or so it seemed to me at the time. So I looked for something that I could do almost anywhere and with hours that would leave plenty of time to pursue my dream. I found a job as a part-time drive-through teller. Later, when I needed a full-time job, I went to work in a startup bank. And even though I didn't start out to be a banker, I found a career in that little bank. The president of the bank was an old-fashioned community banker and a natural teacher. He taught me everything he knew about banking, and that was plenty. 15 years later, when he died suddenly of a massive heart attack, I'd learned enough to take his place as chief executive officer. My banking education began with him as my mentor and with plenty of on-the-job training. Because the bank was just starting up, there were only 11 employees. Lots of work to be done and not many people to do it. I was able to try my hand at nearly every job in the bank and to see the results of every action that was taken. One of those early jobs was reconciling the bank's account at the Federal Reserve and calculating the bank's reserve position. Today, I spend a lot of my time thinking about collective reserves held by all banks and how those reserves impact the economy. My early experiences with making reserve decisions for a tiny community bank makes it much easier to connect the dots between Federal Reserve actions to add or withdraw reserves, bankers' decisions to manage their reserve accounts, and the resulting impact on interest rates and, in turn, influence on the economy. The banking industry has a tradition of teaching basic concepts of bank management through in-house or industry-sponsored banking schools. Once I realized that my talent for banking was much stronger than my natural acting ability, I started going to banking schools to learn about bank investments, lending, and bank management. And I earned an MBA while going to school at night. I soon began teaching bank management in the same schools I'd attended earlier. And one of the best teaching tools I discovered was a bank simulation. I worked with a number of models, helped design a few of them, and ran several hundred simulation exercises over the years. As issues have developed throughout the financial crisis and the recovery, I've had more than a few occasions to be grateful for the deep understanding about how banks and bankers react to various external conditions that I gained from all those simulations. I guess you could say that although I was the teacher, the person who learned the most from those simulations was me. And I've discovered that the Federal Reserve uses its own models of the economy to simulate outcomes and create economic forecasts under a variety of assumptions. Much of my time as a community banker was spent lending to small businesses. In many banks today, small business lending is an automated process that relies on computers to analyze data and determine a borrower's creditworthiness. For me, the process was personal. It involved sitting eyeball to eyeball across the table from my customer. More often than not, the customer was someone I knew well and had been lending to for years. Occasionally, he or she represented the second or even the third generation to run the business. Or the business itself was the second or third venture that I had financed for the same borrower. There were financial statements to be gathered and analyzed. Usually, it was difficult, if not impossible, to separate business and personal finances. But understanding the borrower's ability to successfully run a business was just as important as analyzing the numbers. I spent a lot of time talking to business owners about their businesses. In fact, sometimes I thought they came in looking for a sounding board for their ideas just as much as they were looking for money. I couldn't always make the loan. In fact, especially during the economic downturn of the early 1990s, I had to deal with problem loans. Some were resolved through restructure and some through foreclosure. So now, as a bank regulator in the middle of a financial crisis, this personal understanding of the lending and loan collection process has strongly influenced my policy views. And I've never lost sight of the importance of all those small businesses to local economies and the importance of loan availability to small businesses. I fully expected to complete my career working as a community banker in my hometown. But in early 2007, I received a call asking if I would be interested in serving as a member of the Board of Governors of the Federal Reserve System. I was intrigued, flattered, and more than a little intimidated by the prospect. I had interacted with the Fed throughout my banking career and had even served on the board of directors of the Richmond Federal Reserve Bank, so I knew a lot about the Federal Reserve, but there was no way that I or anyone else could have foreseen the tumultuous events that were about to unfold. The Federal Reserve is the central bank of the United States. Congress created the Federal Reserve in 1913 after a series of banking panics. According to the Federal Reserve Act, the Fed was established to furnish an elastic currency, to afford a means of rediscounting commercial paper, to establish a more effective supervision of banking in the United States, and for other purposes. When I joined the Board of Governors in August 2008, the Fed's ability to respond to financial crises was about to be tested as never before. For as long as they've existed, central banks have calmed financial crises by lending to financial institutions against good collateral. Because central banks step in when other sources of funds retreat, central banks acting in this capacity are known as lenders of last resort. But that doesn't mean that central bankers make bad loans. Nearly all of their loans are to sound borrowers with sound collateral. Banks rely on short-term funding, such as overnight interbank loans or customer deposits, to make the longer-term loans that their customers need. If funding becomes scarce, banks become less willing to extend credit. To maintain the flow of credit to businesses and consumers, the Federal Reserve provides short-term credit to sound depository institutions as needed. To ensure that the banks use the facility only as a backup source of funds, Federal Reserve loans are made at an above-market rate. In the panic of 2008, liquidity needs were not confined to the banking system. The shadow banking system, made up of investment banks, money market funds, finance companies, and investors in a wide range of debt securities, provided a large part of the credit that fueled our economy. When panic set in, it froze lending in banks and non-banks alike and produced funding pressures across a wide range of markets and institutions. The actions taken by the Federal Reserve to fight the crisis were quite traditional in the sense that for years, central banks have been providing liquidity by lending to financial intermediaries. But they were unconventional in that the concepts had to be adapted to fit markets and lenders that had never been supported by the Federal Reserve before. Now, I didn't live through the banking crises of the distant past or those that may have occurred in other countries, but I can tell you what it was like at the center of the most recent crisis. Funding was drying up for one institution after another and for one market after another. Our efforts to provide liquidity were being criticized by some as bailouts for the banks. And I can understand how it could seem that way, but I also know that every action the Fed took was directed at improving the economy rather than the well-being of the banks. We had to make many difficult decisions in the darkest days of the crisis. For me, those decisions were made a little less difficult by several factors. First and foremost was the calm, decisive leadership by Chairman Bernanke, whose lifelong study of economics and economic history provided unique preparation for his own role in history. Almost as important were the hundreds of Fed economists, lawyers, bank supervisors, and market specialists who worked around the clock to craft creative solutions to every financial market challenge. I'll never know how many hours it took to develop and implement all the programs that they presented in a seemingly endless series of emergency board meetings. I do know that they responded to every question and strived to mitigate every risk that was identified. And while the strain was evident in their tired eyes, the collegiality and intellectual rigor that I've come to know as a hallmark of the Federal Reserve never wavered. Finally, for me, was the knowledge of all those small businesses that depended on credit to run their businesses. The Fed provided credit to banks large and small, and in addition, through other programs, we supported securities made up of loans to households and businesses, including loans for business equipment, for inventory, for insurance payments, for business credit cards, and for loans guaranteed by the Small Business Administration. To be sure, lenders reacted to uncertain economic conditions and weaker borrowers by tightening credit standards. But with liquidity provided by the Federal Reserve, loans to borrowers who met those tighter standards continued to flow. The U.S. economy continues to face challenges, but I'm convinced that the forceful actions of the Federal Reserve in 2008 helped prevent what might have been a far worse scenario. The Federal Reserve was originally created to guard against financial panics, but in modern times, many people think of its primary role as responsibility for monetary policy. The Congress has given the Federal Reserve two objectives known as our dual mandate: to foster maximum employment and price stability. In its conduct of monetary policy, the Fed influences the level of output and the level of prices in the economy through changes to interest rates and credit conditions. During more normal times, the Federal Reserve's policymaking is focused on short-term interest rates, our main tool for steering the economy. The Fed influenced the cost of borrowing for everything, from cars to condos to computers, by controlling short-term interest rates. Interest rates can be lowered to stimulate borrowing and spending when demand is otherwise weak, or raised to dampen demand and curb inflation. Before I arrived in August 2008, the Federal Reserve had already responded to the weakening in the economy by aggressively lowering its federal funds target from 5.25% in September 2007 to 2%. From a historical perspective, 2% is an extremely low level for interest rates. But as the financial crisis intensified and the economic outlook grew more more dire in the fall of 2008, the Fed continued to cut rates. For more than 2 years now, our policies have held short-term rates close to zero. And just as the Fed used traditional concepts in unconventional ways to provide liquidity to the shadow banking system and stop the panic, once our main short-term interest rate level was effectively at zero, we moved beyond traditional monetary policy to purchase longer-term assets and push down longer-term rates. In November 2008, the Fed began purchasing large volumes of longer-term U.S. government debt, and agency mortgage-backed securities, eventually increasing the commitment to more than $1.7 trillion before completing the purchases in March 2010. Those purchases put downward pressure on longer-term interest rates generally and helped normalize the spread between mortgage rates and long-term Treasury rates, which had widened during the financial crisis. Reducing longer-term interest rates influences the economy in much the same way as lowering the expected path of short-term rates. For instance, the decline in longer-term rates lowers the cost and increases the availability of capital and credit, which in turn encourages business expansion. In the most recent episode, another important result of lower rates has been a reduction in debt service burdens from existing debt. Households in particular have significantly reduced mortgage payments through refinancing, and numerous small business owners have told me that they just couldn't have survived the downturn without low rates. In November 2010, recognizing that progress toward the achievement of our dual mandate was disappointingly slow, the Fed decided to put additional downward pressure on longer-term interest rates by purchasing longer-term Treasury securities with a stated objective to purchase $600 billion by the end of June 2011. So far, I've talked about what the Fed's done during the time I've been there, but I haven't really told you what the Fed is or what it's been like to be a policymaker there. Federal Reserve is an independent entity within the federal government, in that its decisions do not have to be ratified by the President or any other executive branch official. The Congress, through the Federal Reserve Act, sets the Federal Reserve's goals and oversees it, but the Federal Reserve decides independently how to achieve those congressionally mandated goals. The ability to make monetary policy decisions that are free of short-term political influence is critical for central banks. This is especially true because the effective conduct of monetary policy requires a long-term perspective. A central bank that's subject to political pressure might opt for policies that favor rapid expansion in the near term at the expense of higher inflation in the future. Such actions would surely result in the loss of confidence and credibility that are needed to achieve the objectives of monetary policy. Indeed, research has shown that countries with independent central banks have better economic performance and lower inflation than countries whose central banks are not independent. The structure of the Federal Reserve is uniquely American in its decentralization. The Federal Reserve System is made up of the Board of Governors in Washington, D.C., and 12 reserve banks across the country. The 7 members of the Board of Governors are nominated by the President and confirmed by the Senate. Each reserve bank has a board of directors drawn from business, public, labor, nonprofit, and banking leadership within its district. In consultation with the Board of Governors, the reserve bank directors choose a president to run the bank. The Board of Governors oversees the reserve banks and is responsible for formulating bank regulations, supervising banks, and for making decisions regarding lending other than discount window lending to depository institutions. The reserve banks provide financial services to depository institutions, the U.S. government, and foreign official institutions, including making discount window loans and playing a major role in operating the nation's payment system. Under delegated authority from the board, the reserve banks also conduct on-site supervision of bank holding companies and state-chartered banks that choose to join the Federal Reserve System. Monetary policy decisions are made by the Federal Open Market Committee, the FOMC. While all 12 reserve bank presidents and all members of the Board of Governors participate in FOMC discussions, the voting members of the FOMC are made up of the members of the Board of Governors, the president of the New York Federal Reserve Bank, and the 4 of the remaining presidents on a rotating basis. The culture of the Federal Reserve is an interesting blend of government, academia, and business. Differences of opinion occur regularly, but they're a source of strength rather than conflict within the institution. They add liveliness to the debate and richness to the decision-making process. The system is a treasure trove of data, research, and institutional memory about the economy and the financial system. It is stimulating and occasionally exhausting to be surrounded by so much brain power and intellectual curiosity. But everyone approaches the work with a serious sense of purpose and collegiality. It's hard for me to describe what it's like to work there, but if you ever get a chance to do so, I'd highly recommend it. This brings me to my final task, to offer some career advice to those of you who are just preparing to enter the business world. As someone who has spent more years than I care to count in that world, let me begin where I began. I needed a job, just as many of you will soon. Searching for that first job, or even some of the ones that come later, don't be afraid to take one at an entry level, as I did when I started as a teller, or one that seems quite daunting regardless of your qualifications, as I faced when I joined the Federal Reserve. Look for a career that you enjoy and one that is well suited to your temperament and your talents. Remember that what you think you want most in life might not be the thing that makes you truly happy. I could have been miserable as a mediocre actress. Instead, I happened upon but a well-trained actress. Instead, I happened upon a deeply rewarding profession that I have loved. Indeed, I found that life usually works out for the best if you just let it. Whether you found your perfect career or just a job to pay the bills, make the most of every assignment you're given. I told you earlier about my banking mentor, Bert Harrison. Well, he was always loading me up with projects. And one day, I was struggling to dig myself out of a mountain of work. And Bert came to me with yet one more assignment. So I looked up from what I was doing, and I said, you know what? You bring me work like you're bringing me presents. And he looked kind of startled and huffed on back to his office. And a short time later, here he came back, and he said, you know what? I do think they're presents. And you know what? He was right. Because I learned more from those projects than any class ever could have taught me. Finally, if, as I suggest, that you're going to take advantage of all the opportunities that come your way, I want to stress the importance of lifelong learning to develop skills that you'll need to tackle new challenges. You might very well find yourself pursuing a direction different than the one you trained for in business school, but the lessons you learned here will still be important. You'll need to apply the concepts you know to situations that are different than those you expected to find, and you may need to learn new concepts. Your ability to think critically and creatively, along with your skill at tracking down information you don't have, will be among your most valuable assets. And remember that sometimes asking the right questions is just as important as knowing the right answers. If you get a chance to teach others, take it. Nothing solidifies your understanding of a subject like having to communicate it clearly to others. Use everything you've learned so far, take advantage of any educational opportunity that comes along, and apply what you've learned. That's one investment that I guarantee will yield an enormous return. In closing, I'd like to make a shameless plug for public service. Putting your knowledge and skills to work for the good of the nation is a very high ideal. I think Woodrow Wilson, the president who inspired the Federal Reserve Act, said it well, albeit long-windedly. You're not here merely to make a living. You're here in order to enable the world to live more amply, with greater vision, with a finer spirit of hope and achievement. You are here to enrich the world, and you impoverish yourself if you forget that errand. Aside from the obvious societal benefits, there's much to be gained personally from working to achieve the greatest good for the greatest number of people. It's been richly rewarding for me to bring decades of experience as a banker to discussions on matters that have the power to transform that very industry. And I've been fortunate to work alongside other public servants who share the commitment to bettering the lives of the people we serve by working to ensure a strong financial system and a stable economy. Thank you for the opportunity to spend some time with you tonight. At this point, I'll be happy to take your questions if anybody has one. Yes, sir.
Yes, ma'am. This past Friday, a gentleman by the name of John Taylor, professor of economics at Stanford, wrote an op-ed piece for the Wall Street Journal in which he talked about, and he has some of the objectives that the Fed had, talking about promoting effective maximum employment, stable prices, and moderate long-term interest rates. He went on to say that too many goals may have the impact of having too confusing an emphasis, and that one goal may be better, especially in this day and time.
Yes, first of all, I've been asked to repeat the question. That's going to be kind of hard. But the question had to do with an op-ed written by John Taylor about the dual mandate of the Federal Reserve, the fact that we have two objectives rather than one. And his contention is that we would be better served with just a single inflation objective. And that's something that's been a subject of debate apparently amongst the economics profession for many, many, many years before I ever joined the Federal Reserve. In fact, the first time I sat in on a discussion of inflation targeting, all the people started talking, they said, as I've been saying for 10 years, as I've been saying for 15 years, and it occurred to me, I hadn't been thinking about it for very many years. But we do have a dual mandate, and ours has to do with employment and with inflation. In the long run, if you let inflation get out of control, it's also going to be bad for employment. And so it's not very hard to reconcile the two in the long run, and that's generally what our perspective is. So I don't think our actions would be any different if we had a single mandate than the dual mandate that we had. There's been some discussion in Congress about changing that mandate. That's for Congress to decide, and we are continuing to pursue our dual mandate, and at least at this point don't see any conflict in having those two mandates. The third one that is sometimes discussed as part of our mandate is this idea of financial stability, and the Federal Reserve was created in response to banking panics, and I think it's an important part of what we do, not necessarily an important part of monetary policy. Yes?
Well, first, thank you for the courage to move from comfort to chaos. And in that spirit, I'd ask for a personal view as opposed to a functional responsibility. And it deals with our future, and specifically the role that regulation can and should play in preventing another crisis, and subspecific to that, should Glass-Steagall be reinstated. And I think second is your view of our prospects as a nation to not have a repeat of what we've gone through. And in the broadest sense, what would it take to prevent that?
Boy, I get some big questions here tonight. Frankly, I don't think you can ever prevent financial crises from happening. I think until you can find a way to outlaw greed and fear, ultimately, that's going to happen. Now, you can put controls in place to control the damage, to enhance your ability to deal with panics when they occur, but I don't think you can do away with them altogether. And so in dealing with the crisis, one of the things that you begin to think about is, yes, there are some things we can do that might lessen the probability or the possibility that we'll have this same crisis again, but I suspect that the next crisis will be something different. And so I think it's important to think about what are the appropriate tools to deal with a crisis when it develops. One of the most frustrating parts about this crisis was the amount of it that was outside of the regulated banking system. And so, you could go back and try to reinstate Glass-Steagall. I think, first of all, it's kind of hard to unbreak the egg, and it would be very difficult to do that. So I would go the other way. I would draw the net much more widely, and I think the ability to declare any institution systemically important and bring it under supervision is a very good feature of Dodd-Frank. I think having, you can argue about the individual agencies that are in there or how the council works, but having one body, such as and now I've forgotten the acronym for it, but the Financial Stability Oversight Council, the FSOC, having that with all of the various financial regulators in the same place, talking about items that are systemic risk, I think will also help. I know that the focus of our research now is not looking just at microprudential, it's supervision of individual institutions, but also looking at institutions as a group, looking at markets, looking at financial market utilities. And so I think all of those will help. But I think someday, I don't know whether it'll be, I hope it'll be a very long time from now, but there will be another financial crisis. Yes, sir.
If you go back to 1913, when the Fed was formed, the dollar was worth about 90% of what it was when George Washington was president. So there was a lot of price stability prior to the Federal Reserve. If you go back to the time when you graduated from Carolina, and now the dollar has lost much more of its value than it lost for the 100+ years prior to the founding of the Federal Reserve. So on the mandate of price stability, is it not fair to say that the Fed has failed pretty miserably? And I think also if you look at the banking panics, I would contend that what has happened in terms of economic downturns since the formation of the Fed, they have been longer and more severe than they were before the formation of the Fed.
Let me take first of all on inflation and the value of the dollar. There are a lot of people who think we ought to go back on the gold standard, but frankly, there's not enough gold in the world to provide for the level of commerce that exists now in this country and in the world. And you have to have, I think you have to have a currency that is flexible enough to accommodate the level of economic activity that is going to occur there. In terms of the ability to maintain control over inflation, well, obviously there were some times when inflation was much too high, and so I can't claim 100% success. I can claim absolute commitment, certainly in the Fed that I'm a part of, to not letting inflation get out of control in either direction, either on the upside or the downside. In terms of financial crises, yes, there have been several of them. Whether they could have been necessarily prevented by the Federal Reserve, I'm not sure. Again, my own feelings on the ability to ultimately prevent them is one thing. So all I can really look at is the way that we dealt with it. And I think, again, I don't know enough about the Depression to know how the Fed dealt with it then, although there has been a great deal written, and in fact, Chairman Bernanke has had a number of things to say about it. And a lot of the actions that we took were in recognition of wrong moves or moves that he believes the Fed did that were wrong in the 30s. So I can tell you that on this one, I think we did everything we possibly could. I think not only the Federal Reserve, but the government generally. And some of the actions that were most unpopular, I think, stopping the panic by some of the bailouts of individual institutions, the capital that was injected into the banks, which I think with the most recent payout actually puts the government on a break-even basis on capital provided to banks, and the stress tests that were performed by the Federal Reserve and the results of those that were made public. I think those three factors in particular helped to stem the panic and put the financial system back on its feet at a level that we can now rebuild our financial system and economic momentum. So, it's not a 100% positive story. I mean, obviously, if you look at what happened with subprime mortgages and the Fed's slowness in regulating subprime mortgage lending, I think you have to admit that was a weakness, and that was a part that the Fed absolutely contributed to the last crisis. Yes. You have the microphone.
Earlier this week, the one previous dissenting vote on QE2, Tom Honig, hinted that bond offerings would be extended past June in what's being described as QE3 already. I guess my question would be, where would you see this ending, especially given the mandate that Chairman Bernanke seemed to insinuate about rising equity values in his earlier Washington Post op-ed?
First of all, I would say that the actions that we're taking are contingent on what's going on with the economy at the time. There's not some secret plan to do something different, and we've stated what our expectations are, that we will purchase the $600 billion by June of 2011. depending on the economy that we are faced with, if the economy does as I expect it to and continues to grow all, at a moderate pace, then I think things will begin to come together. If we see further weakness in the economy, then we'll have to decide what seems to be the appropriate action to take at that time. And I think that's really what Tom said in that interview. I think he said, that it's all dependent on what the economy is doing.
I was hoping you could talk a little bit to the role that personal political views play in the day-to-day dynamic of making the Fed governor's decisions. Obviously it's an independent body, but everyone within that body has their own view of how things should run, politically or personally, and I was curious how that dynamic plays out in day-to-day decision-making.
I'll tell you, the one thing I really like about being at the Federal Reserve is when you are politically independent, it doesn't leave any real room for the politics or the partisan politics as you might think of them. So the differences of opinion that we have are more differences of theory and differences of belief in what might be more or less effective. And so in that sense, you don't get the different political leanings on the Board of Governors. What I guess if there's any place that politics comes into it, it's certainly we have come under, there's all sorts of people who have opinions about what we're doing, and some of those are political figures.
I got a question about just inflation in general. So we're kind of in an interesting time now with this dichotomy we've seen between rising food and energy prices, but yet we've seen in the core like almost disinflationary trends. So isn't it just a matter of time before we see these energy and food inflation seep into the core? Because either businesses are either going to have to pass this on, or they're going to have to take lower margins, which is both going to hurt our economy as a whole.
One of the things that was actually surprising to me is that commodity prices are a very small part of what we pay for the goods and services that we purchase. So commodity prices take a long time to creep into the core. We have been looking at all different measures of core inflation as well as total headline inflation, and it is very difficult. With the exception, recently commodity prices have gone up, but if you look over the last year or so, it's hard to find any measure that doesn't show inflation drifting down and drifting down pretty noticeably to really historically low levels. It's my own belief that we may be getting to the end of that, but that's where it's been going. So you look at risk of inflation on the upside as well as risk of deflation on the downside, and we're looking at both of those. In terms of what's going on with commodity prices and more specifically oil prices, the one thing about oil prices different from other prices is that people tend to notice. I mean, people really notice. How many of you notice when you go to the pump? You know what it costs you when you go to the pump. I mean, it makes a real difference and in some ways drives behavior more than the percentage that expenditure would take up in your total budget would lead you to believe. And so we're watching not only actual inflation, but inflation expectations. And inflation expectations over the longer term seem to be pretty well anchored. And so in that sense, over time, because inflation expectations have so much to do with actual inflation, that you would expect inflation to return to normal levels over time. Yes?
Speaking of partisan politics, when the stimulus spending was being approved, there was controversy about how much of that was going to really be effective in stimulating the economy in the relatively near term, and how much might be furthering an agenda for one party or the other. Presumably the Fed was monitoring that spending and taking it into account in its outlook. Can you comment on what portion would be really helpful and what might be subject to some of that criticism?
One of the wonderful things about being at the Federal Reserve is that, no, I wouldn't comment on any specific program, but I will tell you, certainly that's something that we take into account. Whenever there's anything that's impacting the economy, we take into account what's likely to be what's likely to be the impact. So, you know, for instance, if you look at what's going on with states and municipalities, we already know that the federal funds that were being supplied to states are going to be gradually being tapered off this year and next year. So that's something we would take into account.
I'd like to ask you an institutional question. How closely does the Fed work with the Securities and Exchange Commission? How has that relationship evolved? That's the first question. And then the second is, does the SEC have the resources to accomplish the things that people expect it to accomplish?
First of all, I won't speak for the SEC. They have their work to do and we have our work to do. But there are a number of places where we work with them. And you know, in a number of the Dodd-Frank rulemakings, we're working both with the SEC and with the CFTC. Yes?
I noticed that the QE2 seemed to follow on the heels of an announcement by China that they weren't buying as much debt, or they were actually selling our debt. Is there a relationship? Is that one of the purposes of QE2?
No, there was nothing involved in China's purchases that impacted our purchases, and I'm not even aware of that announcement. So I'm not, but no. Yes?
I know it's hard to think back to the time of the Great Moderation, but do you think that lulled the Fed in anticipation of the financial crisis?
That's a hard question to answer. And again, I wasn't at the Federal Reserve during the moderation. Definitely had ended by the time I got there, but it was a time when I was in banking, and you know, when results are good over and over and over again, and we had 15 years of phenomenal performance in the financial industry, and so you know, the longer you have positive performance, it's human nature. You think it's because you've really gotten smart and you've really gotten good. You don't think it's necessarily just because everything is going in that direction. And it did mask the seeds of what ultimately led to the crisis. And certainly, you know, something like, and not just in the Great Moderation, but you look at house prices that have gone up and up and up year after year after year for such a long time. And, you know, I mean, there was conventional wisdom out there that said, buy all the house you can afford, and people viewed it as an active investment. And as it turned out, you know, prices weren't always going to go up as everyone believed. So sure, there's something in good results that does make you let down your guard.
You have come from the community banking portion of the banking industry, and what we've seen during the financial panic is a lot of banks no longer existing, banks consolidating or taking over ones that have been failing and so forth. How do you see the structure of the banking industry moving forward when there's so many worries about too big to fail? What can we look at in terms of the banking industry going forward from this point?
A couple of questions in there. First of all, I think that, you know, every time there's a crisis, there's an awful lot of new regulation. There are new players. There are people that go out. You know, I experienced this in the 90s and dealt with the regulation that came after that. I think you will hear a lot of concern from bankers about the things that are changing, about difficulties. But then over time, once the rules of the road are known, once everybody knows what they can and can't do, then to the extent that there are market forces, there are market needs, you will find somebody coming out to meet those market needs. And the banking industry, as well as the non-bank financial industry, will find ways to provide the products that are being demanded within the structure. I do think, you know, we've seen a process of consolidation in the banking industry that's gone on for 20 years, maybe 25 years, and I think you'll continue to see that. There are, I hear from bankers today that tell me it's just very difficult to do everything you need to do in a very small bank. I was talking to a banker who, it was a family bank. She was the 4th generation to be running the bank. She said, I told my dad it's like trying to run a 50-acre family farm. It's difficult to do at a certain size. At the same time, there are a lot of towns in this country, or a lot of areas where that little $50 million bank is the only financial institution, or is the key financial institution, and that need for financial services is not going to go away, and it's not going to be 100% met through the internet and that sort of delivery system. So my belief is that we'll continue to have the same structure of the industry that we have today. Whether it's 8,000 banks or 5,000 banks, I don't know, but I still see, I'm just a believer that community banks, there's a place for them, and that they will ultimately survive. Yes.
One of the dilemmas of our economy today, of course, is the fact that most economic measures are showing improvement, and it's encouraging, while employment remains very, very steady. Given the structure of U.S. manufacturing today and how it's less mass production, it's more highly skilled, it's more productive, two questions. How likely is it that we will return to the level of employment that we consider normal if there's that much demand, even in a growing economy? And secondly, if we don't, what's the impact on the economy at large of a smaller employment base?
Again, this is my opinion, but I think ultimately we return to a normal level of employment. But it's going to take an awful lot of job creation. I mean, we lost so many jobs. We lost 8 million jobs, and it's going to take, it takes 100 to 150,000 jobs a month just to keep pace with new entrants to the labor force. And so we have to create considerably more jobs than that. However, there's been a lot of talk about structural problems in employment and how long it will take to do retraining or moving, moving workers from one place to another. And at least at this point, that is not the vast majority of the slack that we have in the economy, of the excess unemployment that we have in the economy. So I think it will happen over time. Probably the biggest factor in all of this is confidence. Businesses having confidence that sales will increase, individuals having confidence that they will keep their jobs or that they will be able to find a job. And that's the piece. Right now, it seems to me that most parts of the economy are acting on what they can see. So businesses make decisions based on sales that they know are going to materialize, not on projections of future growth. Bank examiners make decisions on what they can see in terms of loan performance. Bankers make decisions based on the financial statements that they get, not on projections for things getting better. So it just takes it's going to take a change in confidence, which I think comes with a little more momentum and more months of positive numbers. Yes.
Yes, I'd just like to say first, thank you for coming, and thank you for the courage and taking this responsibility on at this time. It's just striking to me that you started at the Fed on August 5th, 2008. September 15th, just a month later, Lehman Brothers, they decide not to bail out Lehman Brothers. AIG is on the verge. It seems like the whole economy, the global economy, is on the verge of disaster. Can you just simply, what was it like?
It was, it's hard to describe. It was frightening, to tell you the truth. It was, I have described it before. The image that kept coming into my head was, did anybody here see the movie The Blob? Do you remember the movie The Blob? And the Blob was this monster. It was just this big old blob, and it would go along and it would eat people or things, and every time it ate something, it got bigger and bigger and bigger. And so it was like this panic was this physical presence, and you just never knew where it was going to strike next. And you didn't know, I mean, before I got there, you'd had Bear Stearns, and then things seemed to kind of settle down. And so when I got there was a lot of concern about Fannie and Freddie, and So actually, before the Lehman weekend, there was the taking of Fannie and Freddie into conservatorship. And then, you know, I got a phone call, frankly, on a Saturday morning saying, you know, we've identified this problem with Lehman. We're trying to figure out what to do. I went in and was there for most of the weekend. Had tons of people, you know, really digging into details, talking to, you know, particularly in New York, talking to a number of institutions, trying to get things. And there are a number of accounts out there of all that was going on during that time. You know, first of all, you had to find a solution that you could vote on. You know, it wasn't like you could say, okay, you know, yes, I'll do this, or no, I won't do that. First, you had to find something to even decide whether or not to do it. So when Lehman failed, then, you know, it was, I think, 2 days later that that we made the decision to make the loan to AIG. And I got to tell you, I mean, you know, I've been making lending decisions all my life, but when all of a sudden you're sitting there and you're talking about lending $85 billion of taxpayer money, I mean, it's a pretty awesome decision to make, but when you start thinking about the possibilities, and everything seemed to be falling apart. I mean, we had heard the money market mutual funds, all of a sudden, you know, there was a run out of money market mutual funds, and you know, you start thinking about, okay, how are we going to backstop the entire mutual fund industry? And so you take actions that you wouldn't in normal times to try to find something that will stop the panic, because again, it goes back to this confidence thing, and you had to stop the panic before you could tackle the real underlying issues. And so it was, you know, it was one week after another of identifying, and the marketplace, you know, you would try to get ahead of it. You would try to say, okay, you know, where do the weaknesses seem to be? But there were two sets of weaknesses. There were the actual weaknesses in institutions, but then it was, you might feel perfectly comfortable with your financial institution, but you didn't know who they were dealing with and what kind of condition they were in. So it was, you know, it was a network effect, not just individual institutions. So it was a pretty frightening time. And I kept waiting for that, you know, in the movies, you have this moment when, you know, the monster's dead, or the, you know, the flood goes away, or the threat recedes. And I kept waiting for that moment, and I'm not sure we ever had exactly that moment, but all of a sudden there was a time when we weren't meeting every Sunday evening, and you know, and things seemed to be a bit calmer, and then we could deal with you know, capital levels in the industry, and leverage, and what was going on with the economy, actually. And, you know, that's certainly been less frightening, but I can't say necessarily easier. One more question.
Not long after Bear Stearns failed, Chris Dodd had a post-mortem on TV that was absolutely fascinating to watch. There was Geithner was there, Alan Schwartz from Bear Stearns, Paulson, Chris Cox, and one of the things they said was that we had never modeled that because we didn't. It reminded me of the old saw, it's not what you don't know, it's what you don't know that is actually going to kill you. If you fast forward a couple of months and the failure of Lehman, it seems like the straw that broke the camel's back was the breaking of the buck by the reserve fund. And that led to withdrawal of funds from money market funds and the complete collapse of the commercial paper market, the drawdown of backup lines from the banks, and that whole cascading. It's hard to answer a hypothetical, but if the reserve fund had not broken the buck, which led to all the rest, could the U.S. system have survived just the collapse of Lehman, or just the problems at AIG, or was it all the after effects of the money market collapse that actually led to the debacle?
That's really, really hard to know. And there had been a lot of work, you know, not necessarily modeling, but there had been a lot of thinking that had gone into, after Bear Stearns, gone into how do we, what systems do we need to do something about, and how might we work to protect the system in the case of a failure of a major investment bank. And actually, some of that we did put in place. I mean, we changed things in the tri-party repo market. There were some things that we knew to do, and we knew to look at what was going on in all kinds of markets, including the money market funds. But it's hard to know. If it wasn't that, might it have been something else? Might it have been something else? And, the things that people learned through the failure, that counterparties learned through the failure of Lehman, changed their behavior in other ways that, that I'm not sure I know. But I think we did learn to begin to look for interconnectedness and things even more so. And this was in an article recently, so it's not something that's confidential, but we do have now a group that does this all the time. I mean, they're looking for what are potential risks, and one of the things that they've been looking at is problems in peripheral European countries. And they had identified difficulties in dollar funding and changes in money market funds as signs of a potential risk of spillover into the U.S. economy from what was going on in peripheral Europe, which is why we then opened up the swap lines, why we basically started lending to other central banks so that they could then lend dollars to their banks so that dollar funding wouldn't be a problem. And so what we learned, I think, was to address the problems in markets and try to understand how that was working more so than individual institutions. Thank you very much.